For those investing in US stocks, this year has been fruitful. Since the beginning of the year, the S&P 500 has surged more than 20%. Several factors are behind this increase. First, the US elections have concluded, stabilizing the situation and boosting market confidence. Secondly, the Federal Reserve is gradually entering a rate-cutting phase, which is a big boost for the stock market. Additionally, the third-quarter earnings reports from major US companies have been quite strong. Thus, the S&P 500 keeps reaching new highs. However, beneath the surface prosperity, worrying signs are beginning to emerge. Some analysts on Wall Street are lowering their earnings growth forecasts for US companies next year. According to Bloomberg data, a measure called the Earnings Revision Momentum Index has recently fallen into negative territory. What does this index measure? It relates to key indicators of the S&P 500's earnings per share changes over the next 12 months. This means the market's confidence in whether US companies can continue to make big profits is weakening. Everyone knows that over the past decade, the US stock market has been rising mainly because companies were profitable. Profitability is the core driver of its rise, but if companies' future earning prospects diminish, the potential for further stock market growth may be limited. Especially now, as the S&P 500 continues to hit record highs, its valuation is also climbing rapidly. The S&P 500's valuation is now at 22 times the expected earnings for the next 12 months, but what's the long-term average over the last 10 years? 18.4 times, which clearly indicates that this valuation is high. Moreover, many large tech stocks are at even more outrageous valuations, gradually accumulating risks in the market. Gina Martin Adams, chief equity strategist at Bloomberg Intelligence, notes that the US stock market has entered a phase of preparing for a reversal. He specifically mentioned that a key issue for 2025 is whether the Federal Reserve can continue to ease policies and if profit momentum will benefit other lagging sectors beyond tech stocks. In the current third earnings season, S&P 500 companies are still performing well. About 90% of companies have reported their results, with overall profit expectations rising by 8.5% year-over-year, nearly double the initial analyst forecasts. This will be the second fastest profit growth rate for a quarter since early 2022. However, despite this, corporate executives remain cautious about future expectations. Analysts have to lower earnings expectations for the next 12 months, especially given uncertainties about Fed rate cuts and US fiscal policy, leading many companies to withhold clear profit guidance. From an industry perspective, the energy sector's profits are particularly bleak. Due to the recent plummet in oil prices, analysts have downgraded annual profit forecasts for energy and commodity firms. Excluding the energy sector, the S&P 500's third-quarter profit growth is expected to reach 11%, still showing strong performance. Nevertheless, corporate profitability still faces multiple challenges. As the S&P 500 index surpasses 6,000 points, its high valuation's reasonableness will depend on whether it can deliver stronger profit performance and clear growth guidance in the coming months. More data shows that the market expects S&P 500 companies to earn about $274 next year, slightly lower than last year's forecast. Meanwhile, Wall Street has barely adjusted earnings outlook for 2025, and this stagnant expectation may pressure market confidence. Adam Phillips, the portfolio strategies director at EP Wealth Advisors, noted that if the Fed's future rate cuts fall short of expectations, it could put more profit pressure on overvalued US stocks. And what does Matt Lloyd, chief investment strategist at Advisor Asset Management, say? As year-end approaches, market forecasts for future profits are becoming more realistic. In the context of unclear paths for Fed rate cuts, investors need to prepare for greater volatility. Overall, while enjoying a boom, US stocks are also facing uncertainties. Future Fed policy direction, corporate profit performance, and the rationale for high valuations are all significant variables that could impact the market. So for investors, it's important to proceed with caution. Over the past decade, passive investment funds like ETFs have risen in global markets, particularly in US stocks. YOMI focuses on selecting the best products from over 25,000 global equity and bond ETFs and mutual funds, creating a core investment pool that ensures stable returns with low volatility.